I think they've done 1.3 in GCI year to date. Phenomenal team, 23 people. He kills it. So if you haven't had an opportunity to meet him or see him or hear him speak, definitely go to that next training. Okay. Thank you. Michael, do you have any broker briefing stuff? And if you do, grab a mic or stand by the mic. Yeah. Or here, we'll give you a handheld. Stand here.
So just looking to see what's relating to commercial real estate, and CAR, California Association of Realtors, is a co-sponsor at SB6. How about that?
No.
So SB6, which the Neighborhood Homes Act, would establish a ministerial approval process for the adaptive reuse of commercial parcels into residential. So you could basically take property zoned for office, retail, commercial, and convert it either into condos or rental housing. So that could be something, potentially good for the commercial agents on this.
And that's been approved already or no?
The bill passed the assembly, and it's now pending vote on the assembly floor.
Okay.
So, or passed the Assembly Appropriations Committee. So look out for that. Yeah.
Right.
Is that a statewide?
Yeah. So
Okay, because I know in LA, in downtown LA, that's what really sparked the resurgence of downtown LA.
Yeah.
And adaptive reuse.
Sure.
so
It's good news if we can make it happen.
yeah, and
right?
it'd just be like, I guess the ADU and splitting the parcels with SB9 into multiple parcels.
Yeah.
So
And then a shameless plug for you today, this afternoon. Are you hosting anything?
yeah, I mean, there's a broker class, sort of question and answer, coffee. Maybe there'll be bagels left over with the broker.
And what time is that? What time is your coffee?
3 o'clock, 3 to 4.
So 3 o'clock.
So-
Again, you guys, a lot of you guys know this, but right, you guys join this office for a reason. The culture that we've created in this office is tremendous. The collaboration that we have, the education, the training, take advantage of it, lean into it. Every other week, we have a coffee with the broker. The alternating weeks, we have the town hall meetings. We have this meeting every single week, Tuesdays at 9:30. So you guys lean into it. The more you lean into it, the more you'll get out of it. So,
and just basically, office procedures, policies, you guys are all mostly commercial. If you have if there's a residential agent that has a potential commercial deal, the policy is they have to hook up with someone here, and I usually direct them to Austin. Correct. To match them up with whomever they need to. So and that's been happening more often.
Absolutely.
Yeah.
And I mean, to reiterate that, guys, it is not just the office policy. It is the National Association of Realtors Code of Ethics, Article 11, Paragraph 11. I forget exactly what it is. If you are an agent and you do not have or possess the special expertise for that particular type of sale or asset class, you are not supposed to work that deal. You are supposed to partner up with somebody that has that expertise.
Right.
So when it comes to a commercial deal, if you are a resi agent, by all means, go to Michael, go to me, go to Josh, and then we will partner you up with the right KW commercial or commercial director or broker in this office to help you with that deal. And that will involve some kind of split, because the last thing you want to do is open yourself up to liability, open him up to liability, and open the office up to liability.
And if you guys have the pure commercial agents that have a residential that they don't want to start schlepping buyers around town, refer it out for a nice referral fee.
Yeah,
And
absolutely.
I'm sure there are agents that would be happy to help. So
100%. Thank you, Michael.
all right.
Appreciate it. All right, let's just jump into deal exchange, because I want to get CoStar up here. That's probably why some of you are here today. Hopefully it was really just to see me, but I think it's more to do with CoStar. Let's jump into, actually, before we get into deal exchange, can you do that screenshot, please? So here's a little bit of education. Commercial folks will get a kick out of this. Resi agents, I want this to be a learning opportunity for you guys. I've blacked out that one, yeah. I blacked out the names here. This is a residential agent that used to be in our office, no longer in our office, now at Compass. And I just want you guys to very quickly read it. And it's a little bit small, so I'll just tell you the subject. Subject line is all cash buyer looking for 1031 exchange up to 4 million, open to area. And then the email body says, have an all cash buyer looking for something with good value add potential, or with a high cap rate, open to single family or multifamily, and open to area. We have looked at things from Oceanside all the way to Beverly Hills, so he's open. Please send me your best investment opportunities. So commercial folks, what do you guys, just quick, shaking your head, Mark? Michael? What is your opinion of this email? The effectiveness of this email?
You know, you have to, if you wanted to pursue, you'd have to call them and qualify. As you always have said to the group, you know, let's drill down on exactly what it is that this person is looking for.
Right.
What is their, is it with an accommodator? Is it not with an accommodator? Sorry.
Yes, sorry.
Is it with an accommodator? Is it not with an accommodator?
Mhm.
As I said, Austin correctly, you have always said, don't waste your time on things going around searching on a goose chase if you don't know exactly what the exchanger in this case is looking for. I'd ask, what's the buy side commission right away before you waste any time?
Sure.
If you're bringing something that, you know, if you're bringing something for this
To the
buyer,
table, right?
and it's a phishing email.
Yeah, absolutely.
basically. So, you know, all we have is our time. We don't want to waste time unless we know exactly what we're doing.
Absolutely. Michael Balson, everybody. Michael Balson, thank you. Aaron Weiner, you got something to say?
Always. Well, the first things that pop into my mind is this a listing or is this a pocket listing? Okay. The next thing I think about it, just before I glaze over, is you and a million other people looking for value add, good cap rate anywhere, got lots of money. And it just doesn't strike the xylophone. I don't hear a tone.
Right.
It doesn't go ding. A light doesn't come on.
Right.
It just,
Grab a number and get in line.
yeah.
Yeah. Absolutely. All right, everybody, Aaron Weiner, thank you so much. Look, Dario just got in here. Jordan just got in here. I'm sure they have plenty to say. So look, here's my take on this. You want to real quick here?
I have a great example. So last night
Wait for the mic.
I get a text from some agent at Compass who I've never heard of before. And he starts asking me, he says, a client looking to develop 20 units. I say, go to my website, right? I have all my listings, et cetera, et cetera. He's like, oh, no. Well, he wants off market. I'm like, you haven't even looked at my website. You haven't looked at what I have for sale. You haven't even asked me about one of those listings, but it's got to be off market. Like, stop wasting my fucking time.
Yeah.
And I told him, go away.
Yeah, no, absolutely.
So it's like this, I should get these, it's a dime a dozen.
Dime a
Well,
dozen.
we're all looking for the same thing.
I mean, and not for nothing, I wasn't going to tell everybody, but this is from Dario. He said, look here, and I don't want to take up too much more time. This is again, a lesson for the resi agents and for the commercial agents. We kind of know what's going on here. Look, when you see a subject line, all cash buyer looking for an exchange, first and foremost, that right there is a little bit of a yellow flag because again, depending on the debt structure of the down leg, they might need to carry some debt for the up leg. So that right there throws me off for a little bit. Everybody's looking for good value add, right? We all know somebody that's an investor at some point. If you find them a value add or with a high cap rate and in any area, you guys, that's not enough. We need more specific. So if you're a resi agent and you're looking for something, partner up with the commercial broker. Let's dig deep and find out really what we're looking for. Please send me your best investment properties. Let me tell you that no commercial broker is going to send you anything here because that's putting our reputation on the line, right? I have a great pocket listing that might fit this criteria, but because I have no idea what you know or don't know, and from what I can tell, you don't know a whole lot, I'm not going to go ahead and put my neck out on the line and send you that pocket listing. So you guys get specific. Remember, every time we have Q&A, we talk, you know, if somebody says I have an opportunity or I have a pocket, you know that I'm going to ask you, what's the rent roll? What's the income? What's the cap rate? What are you looking for? The area, Oceanside to Beverly Hills, that's a huge net. That's a huge net. We want to know where else the investor owns, et cetera, et cetera, et cetera. So just a lesson for resi agents and for newer commercial brokers as well. And a reminder for all of us seasoned guys, like get specific. Don't just throw out something like this because it's not effective. All right. Did you have one more thing you want to say?
Just one time I remember a
You have the mic?
agent asked me for an off market.
Yeah.
A land deal. I send them the off market because he says he's looking for a client. The fucking asshole sends it to my client that owns the property. As an off market.
Yeah.
And then a client was a good friend, written me a new one.
Yeah.
So the worst thing you can do is send to somebody like this that doesn't know who they're talking about, what they're doing, and then it backfires and then you look like an asshole and made no sense.
Today you're speaking a lot of French.
Sorry.
That's okay. Good special guest and
Sorry.
you're just mouthing off left and right. All right, now we all speak that language. All right, let's get into deal change.
I woke up this morning and I woke up with homeless people in my property. So.
So there you go. All right, so Hamid is not here today, but Leslie is here. And we're gonna start off with 1, 2, maybe 3 setups. Some of these you've seen before. I'll just quickly read it for you. I mean, and then Leslie will just give you her email address so that you can contact her if there's any interest. 7812 Manchester Avenue, Faya, 6-unit building. Unit mix is a 3, 2, 2, 2 plus ones, 2, 1 plus ones. And then, can you scroll down a little, please? And then 1 studio. Built in 1959, just under 4,800 square feet, 6 parking spaces, asking price 2.64. Current income is 153. That represents a 17 times multiplier and just under 4% cap rate. At market, you're looking at a 13.5 times multiplier, 5.2%. So 27% upside, located Manchester purchase. And then there's also, from what I can see in the comments, it looks like there might be another. Is this the one that there's one in the middle?
Yeah.
Okay, so this is again this is just one of the 2. There is a third parcel in the middle that is not for sale, not being represented by Hamid. So this is the other one, 7822 Manchester. So again, 2 properties, 6 units each, 1 building in the middle. This one, if we scroll down a little bit, Serena, you'll see the unit mix right there. Also built in 1959, 2.325 is the ask. Upside is 38%. Currently 17.5 and 3.6% for the cap rate. If you have somebody for that, reach out to Leslie. I think there's one more, and then we can share Leslie's contact information if you don't already have it. Can we go to the next?
What's the asking?
2 point, can you scroll down? Sorry. No, it's a different one. 2.325. Leslie, those are available individually?
Yeah.
Okay,
Or together.
or together, correct. Ideally together, but separately available. Yeah, it works. Michael, where's the mic? You gotta grab the mic. So the question, yeah, Michael's question is what happened to the middle parcel? Hey, that's a great question. You know Hamid. Hamid's an excellent broker. He's been in the business for years. You better believe Leslie or anybody else on the team has gone ahead and called that owner to say, hey, are you looking to sell? Because I got these other 2 on the bookends. It's just, yeah, different ownership, and that middle parcel hasn't come around yet, but you never know.
Just a question of price.
Yeah, it always is, right? Hey, and by the way, once you get those 2 into escrow, then it becomes a more serious conversation.
Are the owners, is it the same owner on the bookend?
I believe so. Don't quote me on that because it's not my listing.
It is.
But
It is the same owner.
to buy both, a way, say some, to a buyer, not only do the properties themselves have upside, but if you're on either side and you're patient, one day you're gonna have some real upside.
Correct.
Strangers in the night.
Oh, no. Oh, no. Absolutely. Absolutely. So,
The incentives wouldn't help you because you have to replace all those units as affordable, so you're not tearing those units down.
no, but again, the lot side, can you scroll down a little bit, Serena?
Zoning.
So 6,300 feet, so let's call it 18,000 feet if they are all the same. I mean, it's still interesting. Don't know the zoning, but you can look it up. And if you want more information about it, go ahead and reach out to Leslie or to Hamid, and we'll get Leslie's information into the chat very quickly. Oh, will you scroll down? So those of you on Zoom and those of you in the room, if we can call Leslie right there, 310-432-6547. Again, 310-432-6547. Can we go to there? Do you have one more slide? Oh, it was the one, no. Next.
Is there a map that shows
Oh, yeah.
where it is proximate to the shore?
No. So here's another setup with both properties side by side. All right. So you guys, if you have interest, if you have more questions, specifically, go ahead and call Leslie, stop by her office, stop by Hamid's office. What I also want to say is you guys moving forward for our meetings, if you have a listing, current listing or coming soon or a pocket or an off market, we're going to require that you create a 1-page setup so that we can review it in person here. No, long gone now are the days of us just talking about, hey, I got this and I got that. Because again, as we've seen, we want to make this as efficient as possible. We don't want to just talk about what you might have, what you don't have. If you tell me that, if Masa says she's got something right now, I want to be able to present something to a potential client immediately. So if you don't have any marketing materials behind it, don't talk about it yet. Okay, so we're gonna require that these get sent to me and or Serena by Friday previous week, so that by Tuesday we have these ready to rock and roll and we can just power through this. For those of you that do submit something, the slide will come up. You'll have about a minute to just talk about it, read through it like this, and do it week after week after week after week, because some people might not have been at the meeting, some people might forget about it, some people might have picked up a new buyer. So let's do that, and I'll continue to remind you guys that, okay? Thank you, Leslie and Hamid. No, not today. Oh, fantastic. We'll talk. Okay, good. Next slide. Partner CRE has a few listings that they want to talk about. Yeah, it's in that email. There we go. So you can basically go from left to right. All right, partner CRE. I don't know which one of you guys wants to talk about it. Let's blow this up a little bit.
Oh.
4100 Whittier.
Mic check.
Yes,
Is this working?
I hope it is. Can you guys on Zoom hear us?
Oh, that's what it's for. Just listed this property. It's a completely vacant mixed use property with 6 apartments behind a retail store. It's in East LA, which is unincorporated Los Angeles. The hair on the deal is that a guy, it's not funny. It's really sad. It was a dispensary on the corner and the owner of the dispensary was killed in the store. So then it led to, there was kind of gang affiliation in the apartments and
You gotta become a crypt to buy the property.
it's not crypt territory
That's my
to
fault.
be
Yeah.
clear, but so now it's completely unencumbered. I mean, in terms of like, there's no like real ramifications. The blood's been cleaned up. It's now a vacant 6-unit apartment building with a retail store, super well priced, obviously.
Why didn't that whole story make it to the top bullet?
Yeah, it's
No, because the tenant got the bullet.
Oh, wow. That joke. That joke. That issue. All right, so a little bit of hair on this one.
so, but the good news is that, so my client bought it a year and a half ago and thought it was a slam dunk deal, and they live in areas where they don't see this type of violence, and so it totally freaked her out. And she's just looking to unload it. So, and now it's certainly worth way more than it was when she bought it. And she bought it for about $1 million, $1.1 million, something like that. Because they were, low paying tenants in the apartments. And that's it.
What's the condition?
It needs full rehab.
rehab, okay.
It's not fallen down, but it's in need of everything.
Yeah.
100% vacant.
What's it worth if it's fully,
Maybe $2 million, 1.8 to 2 million.
how much work is it?
Everything.
Yeah,
Yeah.
I mean,
500,000?
no, I mean, it's small. It's so to spend, there's no way. It'll cost you a couple hundred.
You'd have to look at it. So maybe schedule. an
I have
appointment for-
pictures. I've got everything. I've got a full OM.
Yeah.
This is just one page.
Yeah.
So,
Right.
yeah, let me know. I just like blasted it out to some people and I'm getting activity. So
I got an agent at Compass that might want this.
it won't go on the MLS for another maybe couple weeks. So if you have anybody come talk to me, we're over in that area.
Thank you. Man. Appreciate it. Morgan.
Who was that was talking? I'm sorry.
That was
Morgan McMullen. Where's that?
Morgan McMullen with partner CRE. We can go ahead and put his phone number in the chat.
Oh, yeah.
Great.
I
Thank
should've-
you.
Why don't you put the slide in front of you?
Oh,
No,
yeah.
it's not.
Well, no,
I
he
just
doesn't,
got
there's no
this.
contact
I
information.
just put this.
Yeah, I know, but just-
See, even commercial guys can learn something from this meeting, like put your contact information here.
Well, it's there. It's just really small,
By the way,
but maybe not my phone.
No, it's not. See,
He doesn't want people to call.
he doesn't. He wants to drive the price down and take it down himself. All right, next slide, please. Douglas?
Why are we showing this one?
I don't know. You guys sent it to me.
No, go to the next one.
Okay, go to the next one. Primrose?
Primrose is a very nice apartment building in the Hollywood Hills. It's in the Beechwood area. 6 units, kind of classic pre-war construction, really, really well maintained, long-term owner. Wants a big number, maybe some flexibility available. Contact Morgan McMullen.
Big price, big price. I mean, based on the income, right? We're looking at over 21 times multiplier. And guys, for the newer commercial brokers and for the resi agents, notice that this one page setup has no pictures on it. Because really, as much as we like pictures, this is the most important information here. It's just the numbers. We need the numbers. And that's what we're going to talk about a little bit later with CoStar is numbers. Okay, so that's your pitch on that one?
Yeah, pride of ownership. If you have somebody looking for something kind of small building, trophy asset, it's super. It's like, you know, all the units have like crown molding, hardwood floors. They're all like very, they have the original kind of Art Deco style kitchens and bathrooms.
And maintain
and immaculate. Great.
It's a huge lot.
There's not really a big unit, so.
Yeah, it's a huge lot, so you can add ADUs to the back,
Sure.
annoy the tenants, hopefully offer them money to leave and
Yeah.
then raise the rent.
Fully
It's a
occupied,
huge
all
lot.
current on leases or on rents, sorry. Awesome, thank you. Next slide. Yes, Gary. Sure, of course, please. Yeah, this is God. He is speaking to you. Go ahead, Gary.
I think C2. I can't remember exactly. It's C something.
Yeah.
CM.
Do you know how much
It's
land?
it's about 5,000 square feet. It's not a big lot.
Yeah.
Say that again? Correct.
Yeah, the lot size. Thanks, Gary. You know how to reach out. get a hold of
If
them.
anybody wants, my email is morgan@mcmullencre.com. And McMullen is MCMULLIN. Just email me and I'll send you the full setup.
And Morgan's cell phone numbers in the chat, guys. All right, let's go to the next thing. This Douglas,
Skip this.
skip this.
No, this is your Douglas.
Oh, go back.
Oh,
This is that new construction.
oh, yeah.
I have flex here. They'll look at anything with a 4 in front of it. Terms are important. It's 6 units. One's occupied the front house. That's historic. The whole area is HPOZ. The house is occupied for 5250. And then the rest of the units, they're just finishing them up with getting the C of O any day now. We're listed at 495, but they'll probably do it at 42.
And-
That's in Angelino Heights, Echo Park.
And the C of O, same status, still pending?
Any day now, just dealing with the city.
Perfect. Thanks for
Okay.
sharing that again.
No
And
problem.
every week, let's share that until
Yeah,
we
no
sell this bad boy. Next slide, please. All right, and this should be the last slide for today. CoStar, thank you for your patience. Gloria,
I'll talk about it.
talk Gloria.
So this is a warehouse in industrial in Van Nuys. Plenty of flex on this price at 5.5. They'll do it under 5 for sure. The biggest issue with this property is they're squatters. And the owner has no intention of getting rid of them. You can get rid of him by calling the cops. He has he's in the entertainment business and doesn't really want to do anything. But you can get a pretty decent deal so long as you take over the
headache.
squatter situation.
So the structure is there
It's fine, yeah.
and they're just inside.
No, they're outside. They're in
Oh,
the parking
They're
lot.
not even inside.
No, they haven't got, I don't think they've gone. I don't think they've gone inside. I think they're just squatting and
Squatting, meaning they're living there or they're.
I think they have an RV.
Oh, okay.
So I think it's a
And
couple
they're
of
doing
different.
like, they're doing like auto repairs and it's a rough crowd.
Yeah.
So the owner doesn't want anything to do with it.
Right, he won't make it a contingency or anything like
He's
that.
in an entertainment, so he doesn't want the bad press.
Correct.
The flag that goes up the flagpole for me is that they're doing, unauthorized auto. Property.
Yeah,
To
be
contaminate
determined,
without a
could be.
repair takes a long time.
right, to be determined. But I mean, look,
Yeah. they didn't
building
dig
site, I
all
mean, it's a
this
12,000 foot warehouse.
Huh? No.
Contamination is not an issue.
Yeah, it's not an issue. There was a clean phase one when he bought it. He just bought it 2 years ago.
But stuff can happen in 2 years. So still, don't go and, completely blind on it. You gotta go with eyes
Do
open.
a phase one, it's gonna come back with no further action, so.
That's what we hope.
Yeah.
All right, thanks for sharing that.
Yeah.
We've got one last one and then we're gonna jump into CoStar.
I'm looking for contaminated properties. Can be any place in the country.
Right, so Samantha, you need to talk to partner CRE, call Shia or come into the office. You know where we are. We're in that section of the office.
Yeah, we could contaminate.
Yeah, they could contaminate if you want.
Oh, that would be great. Thank you.
Right, last. All right, while we're waiting for this last slide, which we might just push to the end. Again, I wanted to thank our friends from CoStar. We have 3 different people here from CoStar. Aurora is, and pronounce your last name for me again. Veloctis. She is our account executive. She supports our office specifically. She's here to help us grow our subscription in our businesses and be able to help us effectively use CoStar, even more effectively than we use it now. You want to quickly say something, please?
Yes. Hi, everyone. I'm Aurora Balaktis. So I'm your account manager for your CoStar account and also for your LoopNet account as well, if you do have one. So I'm here to help you with any training that you have for any, how to find active listings for sale, for lease comps, sale comps, market analytics, public record, or if you want, a CoStar subscription as well, more than happy to speak to you afterwards. And then on the LoopNet side, more than happy to go over your listing performance reviews, to go over, how much exposure that you're actually getting. And then just a little background on myself as well. Prior to being onto CoStar on the team in the Los Angeles team, I was actually a broker in the brokerage community for the past 4 years until I moved on the CoStar side as well. So I actually have some postcards as well for you guys as well. So afterwards, you guys can just grab them. And then now I'm just going to pass it off to Ryan. He's our Senior Director, Market Analytics for the Los Angeles team as well.
Thank you. And then we'll go. I got my mic. Oh, you got a mic.
Yeah.
And then real quick, before I give you the floor, just wanted to quickly point everybody's attention to Matt Cipollini in the back here, Regional Director for CoStar. He is here to watch over these 2 guys and really to show motion. I'm kidding, guys. I'm kidding. More support, right? More support to show you guys how important KW Commercial and KW Beverly Hills is to the CoStar family. In addition to CoStar and LoopNet, which you guys have all heard, for you resi agents and for you commercial brokers that are doing leasing as well, they also own apartments.com. So if you've ever put anything on apartments.com or look for something on apartments.com, that's also them, but you do not support us on that, correct? Okay, so that's a separate person, and that's a self-serve kind of thing anyways. So thank you again, you guys, for being here. And let me introduce you guys to Ryan Paytap. As Aurora said, Senior Analyst, Market.
Yeah, simplest definition of my job is I stare at LA commercial real estate all day, try to understand it, try to present it, communicate it, articulate what is going on to clients and the outside community. So I've got a presentation here kind of giving an overview of the main commercial property types. I'll start with multifamily, then get into office, industrial, and wrap up with some thoughts on retail. Definitely some interesting things that have happened to these sectors during the pandemic, very different stories amongst them. So let's get started. So I'll start first with the multifamily sector. I'm sure all you're aware, it's definitely been pretty strong conditions over the last year and a half for sure. But just a quick recap in terms of what happened during the pandemic. LA was outside adversely impacted early on in 2020, saw a lot of move outs, vacancy shot up to the highest levels in decades. Haven't seen this as far as our data set goes back, nothing as high as that. But almost overnight, there was a whiplash of very, very strong demand. People came back to the apartments and we saw very strong leasing. And so that momentum has continued, moderated a bit. And we're now at this point where vacancy is at its lowest point in decades. So very, very dramatic conditions over the last couple of years. That being said, though, it's not that unique when you compare it to most other markets nationally. And this is kind of a rising tides lifts all boats situation. We saw occupancies hold up much better in 2020 in most markets of the nation, particularly those Sunbelt markets outperformed relative to the coastal markets. And we saw very strong demand in most places in 2021 as well. We are seeming to reach peak conditions in some of those markets. I think some of them that saw the greatest gains. Now things are cooling off a bit. But still very, very strong conditions, and this is still a landlord's market. Now, this graph here looks at the vacancy rate among the various major submarkets in Los Angeles. Big picture here is options are limited if you're a tenant. even in those areas like downtown LA, 6% vacancy is the lowest it's been in decades, ever since the development cycle got started down there. Vacancy was as high as 14% in 2020. So tight, very, very tight conditions almost everywhere you're looking in LA. And definitely as a result, we are seeing strong rent growth. Now, one of the great resources we have at CoStar is search activity on apartments.com, which CoStar owns. It's a great leading indicator in terms of someone first has to find an apartment, tour an apartment, sign a lease, and move in. And what we saw is very, very strong demand in 2021, the fall off that is typical seasonality that we see towards the end of last year. And things maybe are a little bit more modest in 2022 so far, but still pretty strong activity. And I think should keep vacancies pretty low, at least for the near to midterm, and bar any real changes in the economy. Certainly there are questions there too. And so this is our baseline forecast. And I think, whether vacancy is higher or lower than this, conditions should remain historically tight through the rest of the year, and I think into 2023 at least. Now we'll shift on to rent growth here. At the end of the second quarter, we saw rent growth just under 7%. These are asking rates year over year, which is very strong and the strongest we've seen in at least over a decade. But that growth is really not that exceptional, all things considered. Most other markets have seen higher rent growth over the past 2 years. And so you can really see that here with this graph. This looks at the year-over-year rent growth at the end of the second quarter among the various markets here. And as you can see towards the top left, the Sunbelt markets, Orlando, Texas, those locations have seen exceptional rent growth. And that 6.6 that we saw is actually quite modest and towards the bottom when you look at most other markets. So most areas have done phenomenally in the last year.
Brian, before you continue, I mean, interesting to point on that last slide, if you could go back to that. Yeah. I mean, the Sun Belt, again, seeing dramatic rent growth. Those are also the states and cities that we saw people leaving LA to go to during the pandemic, right? And if you look at the bottom of the list, those are the established metros, LA, New York, San Francisco, East Bay, that people were splitting from. So that's kind of interesting because on the residential side, we've been talking about that as well, right? So, and then the commercial side, we see people leaving all the time as well.
Yeah, it's fascinating. I was looking, this was a month or two ago, and I was just shocked. Average rents in the South Florida markets, some of those are now more than in LA.
Amazing.
That quick of gains of these last years. There was much bigger of a delta before this period. So as you can see, it's great compared to our history, but all things considered, compared to most other markets, not really. This graph here looks at daily asking 1-bedroom rents. And so we index those numbers to the beginning of 2020 kind of as a proxy for where things were pre-pandemic. Message here, LA has lagged most other markets nationally when you compare the green to the gray. Strong gains in 2021. Things have moderated, but still pretty historically strong. Nationally, we are seeing levels kind of plateau. So maybe LA has a little bit more room to run given that it lagged. But maybe other markets are potentially now slowing down. Now, this next graph here looks at rents by unit size within LA. A couple messages I want to point out. Earlier on in the pandemic, 2-3 bedrooms performed better. No surprise to me there, given people are stuck at home all day, working from home, needing that space. Though we have seen 1 bedrooms kind of catch up to those, which I think is kind of a recalibration of our new normal and that people are willing to live in 1 bedrooms, but perhaps less so into studios in the smallest of spaces. So kind of some interesting dynamics there when you break things out by unit size. This looks at concessions. So the percentage of apartment communities over 25 units that provide some sort of concession, whether it's a 1 week to 2 months, just a broad bucket. Yes?
By new construction or
These are all properties, but the big picture here is that we're kind of where we were going into the pandemic. These are the vast majority of these that are offering anything substantial are the new communities that are leasing up. They don't necessarily need to, but they'd rather get their occupancy numbers up to get the building stabilized and potentially sell. So definitely a landlord's market in terms of these metrics. Now, looking at rent growth among the various submarkets, a bit of a mixed message here. Earlier on in the pandemic, it was really the more suburban, affordable locations that outperformed: San Gabriel, San Fernando Valley, Santa Clarita. But now it's kind of a mix where some of those markets that are towards the top are those that were hit harder, but are now playing catch up a bit. So kind of a mixed picture there, but generally speaking, pretty strong rent growth in most areas in LA County.
And on the flip side to that, Ryan, some of the areas that were experiencing tremendous rent growth pre-pandemic, during the pandemic, are now on the bottom of your list. Like I'm seeing Inglewood.
Yeah, some of them actually, Inglewood has lagged. There has been a fair amount of supply, and that has in terms
As
of
of
our
late. K-Town, interesting.
K-Town has always lagged, downtown has always lagged. I mean, when you always have this new supply coming year after year, you just have that competition. Whereas, you're not building in the Eastern San Gabriel Valley or the cheaper areas of San Fernando Valley. And the fact is, so many people in LA cannot afford to buy a house, and they are going to be renters. They're forced to be renters if they're staying here. And that workforce housing is really what a large segment of the population is limited to. So in terms of our outlook for rents, I think if you expect conditions to remain relatively tight, maybe we have reached the peak in terms of rent growth, but still pretty strong gains, I think, for at least the near term. Now, into the construction fronts, LA saw just under 9,000 net new units, market rate, delivered during the last 4 quarters. So the end of the second quarter of this year through the beginning of the third quarter of 2021. So that puts us in the top 10. But when you calibrate it to the size of the market, so this graph is a little complex, and that the numbers are the absolute level of completions, whereas the blue bars is the percentage increase in inventory compared to where inventory was a year ago. And so that net deliveries is pretty modest, and especially when you can, again, compare to the Sun Belt. I'm going to show you a series of graphs for all these sectors, where the Sun Belt's towards the top, LA's towards there, depending where things are in the various sectors. So a lot more development activity certainly happening in other areas of the country. Certainly, though, that development activity is warranted given the population growth and migration that we have seen. Kind of a side note here, LA is interesting, as I showed you before, we're in some of the tightest conditions we have seen ever, despite the fact that in 2021, LA lost 100,000 people. Kind of interesting. What is happening, and as has happened over the past decade or so, is a resorting of people who are leaving and coming and going. And those that are leaving tend to be lower to middle income households, tend to have larger households, and who is coming are higher income individuals or couples without kids. So in terms of that mix, that's how you can see the apartment market and the residential market do so well, despite the fact that we are seeing these population losses. Yes.
Do we know where they're coming from? Like what kind of place, like New York?
Typically the other coastal expensive markets, I think too. This was data I looked at a long time ago, but we are gaining on net people making over 100,000 a year. We're losing people making under 100,000 a year. Of course, there's a lot less people that make over 100,000 a year. So in that we're and so there's, it's a mixed picture, and it's sad and lamentable that we are losing people, but we are also to some degree becoming higher quality in terms of our education levels and incomes in terms of the residents. So trade-offs, I would say. So modest completions. Now, just kind of taking a big picture look in terms of where development has happened in recent years. Apartment development activity is very concentrated in specific areas like downtown LA, K-Town, Hollywood, North Hollywood, Woodland Hills. It's very hard to build in most areas, suburban, low-rise, zoning, NIMBY sentiment. So developers really focus on those areas where they can get deals done. And that's why you see this concentration in development activity in recent years. In terms of what's under construction, we're in the top 10 in terms of 28,000 units there. When you compare markets, kind of, in that middle lower end. But I think that that's warranted given where we are in terms of population growth compared to the Sun Belt markets. But we still have this structural need for additional housing, despite our population really not going anywhere. Construction levels and starts. So the blue bars represent the thousands of units under construction. So we've been at peak levels for LA for the past 5 years. Now starts are the yellow bars, that represent yellow line, that represents the number of units that kicked off construction during a certain quarter. So to me, what this says is developers is pretty much business as usual. Maybe a bit of a downtick this year, but things bounce around. So I would wait another quarter or two before I think that means something. I think sentiment is pretty much steady as she goes.
Ryan, do you have any indication as to why that spike in, like, it looks like maybe Q1 of 2021?
It's when it
Coming out
fluctuates
of the
like that
pandemic?
during a quarter, there's not a particular story. I mean, especially in a market like LA, it takes a long time to commence construction, get a land site, get the, approvals. And so that process is, further down the line in that way, that it's not like people turn on a dime and build in a quarter,
Sure.
you know, like that.
And I saw a few hands go up, but let's wait to the end to get questions.
It's up to, I mean, I don't want
I mean-
to exclude the people on the.
No, and I
the
feel
Zoom,
and I
but
feel bad
do
because
like-
I took too much time, but you might.
Yeah,
you
no,
wanna do
I
a
don't
few?
care either way. I've got all the time. in the
Let's
world.
just do a quick.
I like it. It's
You'll
more
wait?
fun if
Okay,
we
you have
keep
one?
this conversational.
We'll wait. Okay, perfect.
Okay. So construction levels, you know, pretty much consistent picture here. Nationally, you know, we have seen elevated levels, I'd say, through the pandemic. We're at record levels under construction in most markets, so there is a greater supply response. It is easier to build in other markets of the country, and you are seeing higher population growth. In terms of what's under construction, this list looks very similar to what I showed you in terms of what has been delivered over the last several years. The two exceptions I would say are Greater Englewood and East Hollywood. And so there's two kind of the interesting stories with Greater Englewood going on. We include West Adams in that submarket, so you have a couple projects going on there. And then, of course, everything happening around the SoFi Stadium and downtown Englewood and that new node evolving. That really didn't kick off until 2018. The other area, East Hollywood, I think that's an interesting story where you've seen a lot of development activity in Hollywood in recent years. Silver Lake is really hot. Not that you see a lot of development there, but in terms of its attractiveness to younger, affluent people. And so it's kind of meeting that middle. You know, you can offer higher quality new units, maybe at a relative discount to what's in Hollywood, and you're proximate to kind of the East Side LA, all the amenities there. But otherwise, the list looks pretty similar from what it has been. This note looks at sales volume in terms of what sold during a respective quarter. Exceptional demand, very strong investor demand for apartment assets. Certainly has some question marks in terms of where things could be going with the recent spike in interest rates. A lot of uncertainty there. Our data isn't showing price declines just yet. I do kind of wonder where things are going, especially in a market like LA where cap rates are so low and the negative leverage issues. But nationally also very, very strong investor demand throughout the country. So LA is not unique in terms of that. Over the last year, we're about in the top 5. So that's pretty good. And maybe there has been a bit of a relative shift in terms of the slice of the pie of greater investor demand going to those Sunbelt markets. But LA is still, you know, very much so in demand market. This looks at national activity. And I like to show this because kind of just taking a step back in the relative shift in investor demand towards the industrial and multifamily sectors. And so on a national basis, this kind of compares side by side activity, sales activity. Message here is multifamily and industrial have seen increased activity since the onset of the pandemic, outsized compared to office and retail. And when you look at pricing, I think the reason why this is happening is pretty clear. This looks at pricing index to 2007. So we go through the GFC, get out of the GFC and where things have landed. The green and yellow lines you can see are industrial and multifamily. I've seen outsized appreciation over the last 10, 15 years, whereas retail and office have really lagged and hotels really were hit during the pandemic. So that has really also, you know, fed on itself in terms of investor demand, strong price growth, and the cycle continues. In terms of outlook for pricing, you know, we are seeing pricing increasing here. I think there's a lot of uncertainty here, though. I think around pricing, that's the biggest metric that I have most uncertainty around. In terms of fundamentals, I think that there should be strong demand going forward. But we are forecasting modest price growth, but probably towards peak gains at this point. I'll now shift into the office sector. Does anyone have any questions before I go?
Go back one slide.
And grab a mic if you don't mind. Oh, you're just taking a picture?
Yeah.
Never mind.
I can give you guys a PDF of this.
Yeah,
afterwards.
that would be great.
That's the first question everyone asks when I go to these things. So let's go to the office sector, and definitely not as much of a positive picture to be painted here. It's been bad, to say the least. This first graph, though, makes things actually maybe potentially look good. And this looks at gross leasing activity. This represents the square footage of leases signed during a respective period. And so activity has gotten back to pre-pandemic levels. That being said, we're seeing plenty of move-outs, tenants vacate upon expiration, tenants vacate and put their space in the sublease market. And so while that is helping to offset the move-outs, it's not enough. And we're kind of getting towards peak levels there. Nationally, I think the picture is pretty similar here. What has happened in LA over the past year or so has happened in most other markets.
Excuse me,
Yes.
that gray, on the
Yes.
top,
is just appearing this year. What is that?
That's an estimated figure. And so we're tracking leases as they're inputted into CoStar. You know, a broker puts their space on there, they list it, they remove it, they note the lease cop. There sometimes is a lag in terms of when that lease was executed to when it enters our system. And so that's based on history, what we estimate to be the additional volume that will come in over time. As you can see, like it is smaller as you go further back. So it's
Oh, I see. I see.
Yeah.
That'll always appear in the last few quarters.
exactly, it'll be bigger towards the end
Got it.
because we
Okay.
will miss more just because it doesn't get inputted
Right.
into a certain point. So yeah, and so pretty similar in terms of what's going on in LA here. And so I guess the saving grace with that is vacancy has peaked at least for the near term, and the swift rise we saw in 2020, much of 2021 has cooled. That being said, vacancy is at the highest level it's been in decades. It will take a long time to get to anything resembling pre-pandemic conditions if we ever get there. Nationally, pretty similar picture there. Vacancy spiked incredibly in 2020 and 2021, and now kind of peaking off here. Definitely some questions in terms of where things could be going. We are showing kind of things peaking, but I also think there's questions on how many tenants have kicked the can down the road with their space decisions. They're committed to their lease term. They're still trying to figure out in this new world of hybrid, flex, remote, full back in the office. Every company is thinking about these things differently. So a lot of uncertainty there too. This graph looks at vacancy by the various submarkets in LA. Message here, tenants have ample options in most areas of the metro. The premier markets like Beverly Hills, Silicon Beach, Culver City, Hollywood, these places have seen vacancy double over the last 2 years. And so that's concerning in terms of these are the locations where the more premier tenants are: tech, media, creative, what makes LA special in terms of an economy. Conversely, you have a few markets towards the bottom, but generally ample options. Sorry. So this graph looks at the amount of sublease space that is on the market. So a tenant is committed to a lease that it's signed. It can try to have another tenant pay for that, the rest of that lease, but they're still on the hook for the rest of the term. And so this is sublet space. It has doubled during the past 2 years. We did see things kind of come down in 2021, but things are starting to move up again. And so this is another metric that I keep looking at, and will definitely have to come down in terms of trying to see that if for the market to get to anything stronger.
Ryan, that
Yes.
last, and maybe you're about to ask us, that spike in the last bar, is that including the Netflix sublease?
That includes some of that, and then there was a 500,000 square foot space in Woodland Hills. Cannot remember the insurance. State Farm, yes. They put up 500,000. Was it that or Travelers?
Yeah.
Okay.
No.
It was State Farm. Okay.
At least they moved from LA, their classical building
Yeah.
in LA. They moved to Woodland Hills, occupied a whole building, and now they completely emptied that out.
Yeah, I mean, it won't get held in my opinion, but it's up there. Someone wants 500,000 square feet in Woodland Hills.
Now, if you add the vacancy, I mean, these numbers, sublease numbers to the vacancy rate, is there any number that you'd say there's a combined vacancy rate of?
Sorry, I'm not following you.
If you were to add, the vacancy rate is only on the market for lease empty, right?
Yes.
Then if you got
This will
your
be,
sublease
I
numbers,
see
if
what
you
you're saying.
added them together, what would the vacancy rate be?
Well, so this is a mix. And so sublease space can be physically vacant, or the tenant can still be occupying it. And so then if that's the case and they don't list it as vacant, then it doesn't fall
Show
into
up.
the vacancy number. It'll fall into availability.
True. It isn't necessarily a vacant space, but it is available space.
Exactly.
It's competing space.
Exactly. And so, yeah, we talk most in vacancy, but you do have to look at both numbers in terms of what they mean. There's a reason to look at vacancy. There's reasons to look at availability. And so, yes, that would suggest even more slack if you're looking at.
So if you dissected this into vacant and or available, that vacant part is already captured in the vacancy
Right.
rates, but the available,
Right.
you
Is
could add
not.
on, tack on.
And the message is, if you're a tenant and you want to get out of your space and sublease it, it's you're facing really strong headwinds right now. You
Yeah.
really have to discount the rate to compete with the landlords that are getting very competitive.
Does it also tell you that people are moving out in the future?
Yeah, I mean, we've seen that on net just in terms of where the vacancy is leading, because we've seen respectable activity in terms of tenants committing, but that means on the back end, that tenants are continuing to vacate spaces. So in terms of the outlook, I think it's highly uncertain. We don't know how this whole great work from home experiment will play out over long term. I do think it will take several years to see kind of the percentage of firms that go hybrid, flexible, remote, or all back in. I think more than not, hybrid is here to stay for most firms. That doesn't mean the office is dead, but it probably means a net contraction in terms of the total amount of space we need. And so this is speaking about the market in a market-wide perspective. But I think going forward, there will be bigger winners and losers in the office sector. Prime locations, prime buildings, lower rise with outdoor space, cool, creative, industrial. Those will probably do better. 80s towers, marble clad lobbies, not cool, not hip, downtown towers. My bet is those will not perform as well. On rents, this is kind of interesting here. We actually haven't seen much of a decline in asking rates because landlords are hiding the effective, with concessions. We know in terms of individual deals that effective rates are lower, but it is interesting on an asking rate basis, they are trying to save face, so to speak, in holding up those rates and are hopefully hoping for better days and trying to just kind of ride this stuff out in the near
Kind of
term.
blindly hoping for those days though, right?
The landlords that are holding up the rates are the big ones. And they're very well capitalized. They play the long game. And the little guys just kind of draft them. They just follow suit. When the big guys start to drop their rates, everybody drops their rates. So it'd be very interesting. I know you don't dare go past the present line, but I suspect that the rents will start to sag. As this continues.
Well, I do show you a forecast, and we do see modest rises, but again, I think that mix between buildings in demand, not buildings out of favor.
Yeah.
It's hard to look at it just as a whole market wide.
Got some construction going on.
This graph here looks at rent growth among the various metros, and LA is not in here because it's in the middle. I do just want to kind of show the contrast here in that most areas have seen pretty soft rent growth, but the exception would be some of the higher growth West Coast markets and Sunbelt markets. And so some areas are, more favorable in terms of the market. And so it's not a terrible picture everywhere across the country. So in terms of outlook here, we do see gains resuming. Again, I think there's uncertainty. I think certain buildings will have to see rental rate losses. Some will maybe hold up better. But it'll take some time to also flush out space decisions longer term too, and how that flows into rents. Construction levels. So over the last 4 quarters, we saw 1.5 million square feet of net new office space added to the market. Not a lot. We have around 440 million square feet of office space. So definitely not, it doesn't impact the market. It's very specific situations, higher quality buildings, and very specific parts of the market. And in terms of this net delivery, so again, the blue bar represents the percentage increase in supply versus, and the number represents the absolute number. LA's not on here. It's in the middle, pretty modest growth. Generally are seeing that, but you are seeing some markets. Interestingly, the tech markets are still seeing heavy growth, like San Jose, San Francisco. San Francisco in particular has been doing very bad, among the worst, I would say nationally. So some areas do have to worry about supply more so than others. This graph here looks at starts and under construction, like the one I showed for multifamily. Construction levels have peaked and we're moving down. We're now around 4.5 million square feet. That's pretty good. We will have to digest it. The other part was starts here. Developers have held back over the last 6 quarters or so. There definitely is a risk off in terms of developers starting new office projects. Pretty logical to me. And so, that is the market trying to figure out what is going on. Similar picture to a lesser extent on a national front. Now, when you compare our construction levels, that kind of puts us in the top 10. With sales activity, actually, I've seen a decent amount of sales activity happen throughout the pandemic era. When you look at what has traded earlier on, definitely the higher quality, well-leased, bond-like real estate, higher quality locations. Some of those really haven't seen a discount. Conversely, there have been buildings, most notably Union Bank Plaza just traded last month. That sold for $225 a foot. Downtown Office Tower, sitting in Southern California, it's pretty bleak. But, you know, so the buildings are challenged, the buildings are kind of more average, whether it's, so it is a bit of a mixed bag, but there is investor demand. Nationally, pretty similar picture there too. In terms of sales activity over the last year, just kind of, you know, we're in the top 5 to 10 in terms of markets. In terms of the outlook, again, I think this is going to be very stratified. Certain buildings are clearly seeing asset price losses. On net so far in terms of what's traded, the numbers are showing pricing growth actually. And I do think that you will see some assets. You've got a lot of interplaying factors here. You have a sheer amount of capital that is out there and needs to be invested in commercial real estate by institutional sources. A lot of it is allocated specifically to office. So there, even if you're all concerned about what's going on, there's still these mandates, right, that feed the investor demand that then does have the potential to continue to cause price appreciation. But I do think we're going to see winners and losers, particularly on the pricing front, most the office sector. Does anyone have any questions on office before I get into industrial? All right, let's get positive again. This first graph actually makes you think it looks negative here. And so looking at that gross leasing activity again, we have seen things moderate. Yeah, things have cooled down after an exceptional 2021, which stands in contrast to most other markets where you have just seen activity continue with, you know, unrelenting. But there's another part to the story here. Vacancy right now in LA is just under 2%, which to me essentially means no vacancy. There's a certain amount of space that is just not usable for most industrial space users. It's going to sit there for a while. Very limited options for functional space right now. And so, you know, even if you look at like through 2016 to 2020, vacancy kind of bounced around here and there. And that was basically saying that there was no vacancy then, but you had move-ins, move-outs, just kind of the cyclical flow of things. And so really, when you look at that restrained leasing activity, that to some degree is a product of a lack of supply than a lack of demand, just because there's nothing else to lease.
That's LA County?
Yeah. Yeah, so we break out the markets, LA County, Inland Empire, Orange County, they're all separate. And so nationally, it's pretty similar picture here. And so I guess another point I want to point out is LA and Inland Empire are the tightest large industrial markets, both under 2% vacancy rates. Just really, really exceptional in terms of what has happened here. But it has been good in most markets too. Vacancy is the lowest it's been in a decade on a national basis. This graph here looks at net absorption. LA is not on here again because there's only so much space to lease, vacancy so low, but do just want to show you kind of that these other markets are seeing incredible amounts of leasing activity happen. Just very, very strong conditions. Now here looks at that net absorption on a percentage basis. And so it is low, but again, again, that lack of supply versus demand factor. And the Inland Empire, you know, kind of stands towards that middle top range.
The Inland Empire is going to be dropping, that number is going to be dropping because a lot of the cities in the Inland Empire are placing some moratoriums on new industrial construction.
Yeah.
While they figure out what to do with all these industrial buildings that are changing the complexion of their communities.
No, yeah, it's a complex issue for sure. And that, because, you know, the story of the Inland Empire is that that's where you can actually get land, you know, and then
Used to be.
it's going to start to become the, you know, just like LA. But,
It's Victorville next.
well, yeah, and then they're going to have to go to Victorville because then I'm assuming the towns out there will be less restrictive because they'll want the development. So yeah, you know, very, very strong absorption levels throughout the country. But it's important when you look at the market to look at it by size range. You know, a small mom and pop tenant is very different from a 3PL firm. And so, but regardless, whether you're a small user or a large user, there are very, very few options right now in all size segments of the market. This graph here looks at the median months industrial space stayed vacant on CoStar, looking at LA, the orange line, and blue on a national basis. Record low time in terms of how long space sits on CoStar before it's snapped up. In terms of the outlook, we do expect conditions to remain very much so landlord favorable going forward. You know, whether vacancy goes up 0.5% or down 0.5%, still means very, very limited options for tenants. And so that should drive still pretty respectable rent growth. Probably not as much as we've seen, but still, if you have vacancy this low, that should still suggest rent growth. And nationally, pretty similar picture, but there is more supply in most other markets, and so that will start to see vacancy move up, but still be landlord favorable in this scenario. Now looking at rental rate growth here, in the second quarter, LA just ended with just under 15% rent growth, well and above anything it has seen over the last 2 decades, and among the strongest nationally. Looking at rent growth among the markets here, most areas are seeing incredibly strong rent growth in the US, but LA and Inland Empire continue to be towards the top. What makes that even more impressive is that LA and Inland Empire have seen outsized rent growth for years. And so you think to some degree there is a bit of a catch up. If you go on so far, other markets will catch up. But just given how tight these markets continue to be, you continue to see this exceptional rent growth.
Can you explain that sustained high level of rent growth?
The limited
I
vacancy.
mean, just
The biggest port in the country.
Yeah.
LA Long Beach
Right.
Port Complex, the biggest in the country. It's where we trade with China, we trade, and so the demand's off the charts. Really, it's a question of how high can you go? How high is sustainable?
Yeah. No, I mean, there are limits. Ultimately, you have to be able to afford the space, but sustained, that's crazy.
Yeah,
Yeah.
in Van Nuys, for instance, it probably would be cheaper to store your stuff in an office building in Van Nuys than in a warehouse in Van Nuys. I mean,
Yeah,
the
no,
rents
without a
are, the
doubt.
rents are north of $2 a square
Yeah,
foot
yeah,
for
yeah,
industrial
yeah.
space.
Hey, maybe that solves the office issues.
It's a very interesting point to that on supply in upcoming slides. Very strong rent growth that we see in most markets. And the outlook is we do think rental rates have peaked, but still very, very strong gains if the market's going to be that tight. And with the outlook still towards the top in terms of those markets. So just, really in terms of the wherewithal these markets have, it's very impressive. Net deliveries. So this looks at the millions of square feet that is delivered over the last 4 quarters. LA is not on this list because it doesn't see a lot of development activity. And so LA is very unique among most markets nationally, and that it doesn't, among the major markets like Dallas, Chicago, Northern New Jersey, you don't see the supply response because there is no land to build. In order to build industrial in LA, well, maybe there's a few sites in San Gabriel or Santa Clarita Valley, but you're having to demolish a building. And up until these last couple of years, that building and that site almost had a higher and better use for almost any other property type, office and multifamily principally. What is changed in the last years, and it'll be interesting to see if this momentum shifts, is you have seen people buy office properties, lower rise, larger land sites to convert to industrial use. We are getting to the point where industrial buildings in LA sell for $500, $600 a foot. In Torrance, an office building isn't selling for $600 a foot in Torrance.
We'll look at Union Bank Plaza.
Exactly. Hey, turn that into a vertical warehouse if we could. That'd be pretty funny.
Well, if you just knock out every other floor, then you'll have some good share, right?
Yeah, no, yeah, you're right.
No engineering behind that. Don't worry about it.
Well, the other thing I love is everyone says that, oh, we should just convert all these office buildings into multifamily. Doesn't really work in most cases, just given the floor plates, the depth from the elevators to the window lines. It's gonna be very dark, narrow spaces, very unattractive. Maybe some older, smaller ones you can do that, but it's not gonna save downtown LA and those major towers for sure. Getting back to industrial, and so what is interesting here is we did see more than 1.2 million square feet of industrial space built, but we see demolitions. And those demolitions are for other property uses or to convert the site from an old 70s obsolete building to a latest and greatest modern distribution space. And there is demand for LA in that, but in many cases, a lot of that demand goes to the Inland Empire because the rents are cheaper, you can get larger spaces. You're really paying the premium if you want modern distribution space in LA County.
The other tough thing about LA County is the development timeline. Great, you bought a piece of land, that building's not going to be available for 2.5, 3 years. Where Inland Empire's got a little more ready because it's got inventory, so it's a little more ready to lease.
Yeah, the market's so set up to get these land sites, and investors are focused on that. So construction activity, kind of pretty similar levels over the last 5-7 years or so. And in terms of starts, very similar there. But it's very modest when you look at what is under construction. Nationally, development activity has just continued to ramp up. We're at record levels throughout the country. And so, we're anticipating still strong demand, but if there is a downturn, other markets are more at risk than LA, just given that we don't have the supply there to create slack in the market. Now, looking at what's under construction, LA is not on this list again. We got, I think, around 4 million square feet. We have between 900 to 100 million square feet of industrial space, so drop in the bucket. But other markets are seeing much more robust supply pipelines. And again, to calibrate what is under construction to the size of the market, LA is seeing a sliver of new space added, in contrast to many other markets where, Phoenix, you're seeing 12% supply growth. So if there is a downturn in demand, markets like that are going to get hit much harder than like LA.
Where's Spartanburg?
South Carolina. Okay. Yeah, that's kind of funny. Sometimes yeah. Investor demand for industrial properties has been exceptional. Multifamily and industrial in particular have really been the darlings to the pandemic and pre-pandemic, but that shift in that preference has only accelerated, if anything. Nationally, very similar picture. When you compare what activity over the last several years, over the last year, LA and Inland Empire are still very much showing demand. Dallas is incredible amounts of new supply there too, so that creates opportunities for sales as well. Atlanta, same picture. And so yeah, but just very strong demand across the board. This is a graph I showed earlier on. Just want to point out again, this is fueling that investor demand, that incredible appreciation we've seen over the last 15 years. And the outlook is to see pricing continue to increase. I think there's some questions around that for sure. I think what we could see in the near term is a divide between, and this is in some ways typically isn't the case, but I think there will be greater demand or pricing will hold up for buildings that have near-term lease rollover, because you can sell the story of raising the marking the rents to market, getting that higher cash flow based on the existing rents. Whereas I think properties that have a longer-term lease, those may have issues in terms of when it comes down to negative leverage. That being said, there are plenty of unleveraged buyers out there, and they could see this as an opportunity in a less competitive playing field to buy assets, and so that could sustain pricing. So a lot of push and pull here in terms of where things could be going for the near term. Does anyone have any questions on industrial before I go to retail? All right, thank you for staying with me on this. I will be wrapping this up with this. So retail is, not saying things are great here, but certainly not. I'm more optimistic than the office sector these days, and I think there are some silver linings and some notes of positivism to think about here. And this looking at leasing activity here, back to pre-pandemic levels, but pre-pandemic levels were just kind of not that great too. But it has come back from the pandemic. Retailers are back out there seeking spaces. Nationally, we're seeing that as well, if not a bit of a stronger response. Now, looking at supply, demand, and vacancy, we have seen vacancy peak actually, but it was rising for years, and there has been that downtip, that little bit of decline there. So that demand is positive, and potentially the market is starting to stabilize. Nationally, probably a bit of a better performance in most other markets, and this is being driven by the Sunbelt markets. And, just to kind of look at this again, this is net absorption as a share of inventory. Really seeing that leasing happening in the Sun market where there is population growth, new rooftops, that is really driving that demand for retailers to locate in those areas. Conversely, the markets towards the bottom are those lower population growth areas and, don't see the population gains. In terms of where the market is heading, first off, retail is the most stratified of any sector. Even in good times or bad times, there's very different stories when you're looking at the various property types, high street, commodity, location-based, all of that. But in an aggregate, we do see the market continue to improve at a pretty modest pace, and see kind of declines for at least the near to midterm. In terms of rent growth, we actually have been seeing a pretty decent rent growth, just around 4%, which is, about as high as we saw in the last, through the 2010s. So that's pretty favorable. But it is less rent growth than other markets, for sure. And this looks at it on a national basis. And when you compare those numbers to other markets across the country, again, those Sunbelt, higher growth West Coast markets, that's where you're seeing the greater rental gains.
This also potentially could be explained by the fact that in LA County, we were locked down for so long or longer than other parts of the country.
In terms of hitting the retail market harder and having
Right,
retailers
exactly.
come back. Absolutely. Yeah, no, for sure. In terms of net deliveries, LA is not on this list. LA doesn't see a lot of retail development activity. And this is kind of another similar to industrial, often a higher, better use for those sites, given the fact that we have kind of these meh retail centers. And so you do see development activity, but you also see demolition activity. And so when you look at activity in an aggregate here, we actually saw inventory decline over the last year. So we have seen some projects complete, but there is that obsolete older retail being taken off the market for other uses. This graph's a little complex, just to beat this point in your head. This looks at the percentage inventory growth during a respective year, looking at the additional space added, retail space added during a year compared to the amount of space that existed at the beginning of that year. And so the message is we've seen this, sustained decline in development activity from the 80s, where we saw really high growth, moderated in the first decade of the century. And, for the last 10 years, we've really seen almost no new net retail supply. And so I think that's good. The market is recalibrating, right sizing. Retail isn't dead, but there certainly are centers we just don't need anymore. In terms of what's under construction, only 1.6 million square feet, over 400 million square feet of inventory in LA. So supply isn't going to be an issue in terms of impacting market fundamentals. It'll be all the other variables that will be of impact. Starts and construction activity, pretty modest starts and construction levels over the last year. And when you add in the demolitions, really no net supply. Nationally, more so, definitely have seen more construction activity on a percentage basis than most other markets, but that amount of construction has, started to decline over the past several years as well. Sales activity, pretty strong sales activity. And at this point, varying strategies in terms of what's going on. Ample demand for triple net leased properties up until this point. Maybe with the interest rate rise, we'll see. Higher quality, well-leased, grocery anchored centers, redevelopment plays, land sites. One of the saving graces for retail is that land is valuable here. And so that dead retail center has a higher and better use 99% of the time. That's not the case in some of the Ohio markets in contrast. And so, very interesting, a mix of strategies of what's driving retail investor demand. And, seeing that, markets come back pretty strongly in other places too. But this is in contrast to multifamily and industrial that has seen even more of an increase. In terms of sales, we're in top 3. That's pretty logical given the size of our market. And in terms of the price outlook, we do see gains, continuing. We have seen price growth through the pandemic. This is talking about the whole market, though. I think you're going to see this, and it has been stratified for years. High quality, low quality, location, center, tenants, all these variables. It's really hard to paint this sector in particular with a broad brush. All right, so that is all I have in terms of the slides today. Here's my contact info. Does anyone have any questions? Yes.
Before you ask, make sure you have a mic. And I got to tell you guys, for commercial folks, you're used to hearing numbers and seeing numbers like this, and sometimes it can get dry. For you resi agents, this is what we do all the time in the commercial world, but you did an excellent job. I mean, it was very informative, very entertaining. Entertaining might be too strong a word, but it was easy to follow. It was really very informative. So thank you so much. And then I'll let Q&A.
Great.
Yeah, thank you
Proceed.
for doing that. It was helpful. Just 3 questions real quick about the multifamily.
Okay.
1, do you have any information on micro units? I know you mentioned the studios that are low, but there's a lot of supposedly micro units market that's coming online.
We won't segment that. We'll have them listed as studios. And so, yeah, that it is a whole other different market from just your traditional 500 square foot studio. So it's limited in terms of what's available there.
And second thing is, I know about the construction starts that you saw. I'm wondering if you hear anything about regarding the city, the building department I know you guys follow permits, but as far as the homelessness and the SB8 and the SB9 and how they've all have new employees and they're dragging their feet on everything and everything's taking so long, do you see that in the numbers at all as far as not starting new construction because of the time and the politics?
I mean, but that's always been a variable in LA for, that's how long, I moved here 8 years ago.
So you haven't seen that, you don't see any of that?
And maybe there's been a little bit of a shift to the Sunbelt markets, but the numbers are still showing record level of transactions in 2021. So, maybe there's a sliver that is shifted off, but it hasn't been material in terms of what we've seen in terms of demand.
Thank you. And final question. Where do you guys get your multifamily rental comps?
Well, we have a couple. The primary is through apartments.com. And so we get feeds from those communities into the CoStar database. And so my understanding is we have 100,000 rent observations that are collected daily. And so that it really has a lot of interactivity in terms of the data feeding through into the system.
You don't offer that as sold comps to us, right? As to the users, because apartments.com doesn't have stuff that's actually been leased. The data doesn't come to us.
We get the data points from them to go into CoStar. We're not giving you individual rent comps themselves. They're not going to provide that. But in terms of aggregate, where have rents moved in the building, we're getting
Hola, Iván, ¿cómo está?
through apartments.com to feed in.
Usted va a estar en Beverly Hills
You
hoy.
need to mute yourself online, please.
Hi, thank you. It was really interesting. Do you have any information on expenses, on building expenses?
We do have some market data that has in the market reports. I think if you do a PDF of the market, I don't know how much you've been in CoStar, but I think there are numbers there in the Metro reports, but that's my understanding is the only spot where they're at.
Okay, thank you.
Yes.
Here, grab a mic.
You got a mic.
Hi, just from having fielded the calls from your researchers for properties I'm responsible for years, you guys are always very good and very thorough, but the place where we go for expense information is BOMA, Building Owners and Managers Association, Greater LA. The BOMA Experience Index is what you all look at and what we look at to know per square foot CAMs.
Okay.
Have you noticed any trends with the interest rates, which you've mentioned a few times going up, where you see a lot of loans coming due on multifamily?
Haven't been tracking that as much. And, just in terms of pricing, it is interesting. I have heard anecdotally some deals falling apart, people asking for 5-10% discounts. That's not showing up in our numbers. Admittedly, there is a lag, and so that could be coming. And so I'm continuing to watch it, but so far we haven't seen that impact on pricing just yet.
Any other questions? All right, Ryan, again, thank you so much, you guys.
Thank you. And here is my contact info. If anything does come up, shoot me an email, give me a call. That's what I'm here for.
You mentioned about the PDF, so we just send that to direct.
I'll send it to you.
Just gonna send it to me,
disseminate.
and then for a small fee, I'll send it to you guys. Thank you so much.
No, thank you
Really.
for having us. This is great.
Yeah, no, that was awesome.
Stop and share.
If we can have your email in the chat, that would be wonderful.